Hello everyone, welcome again to our YouTube channel, Hybrid Accounts. And today we're just going to take a look at a new standard called IFRS 15. Actually, this standard speaks of revenue from contract with customer. It simply speaks of revenue recognition from contract with customer. How do you recognize revenue? How do you recognize revenue? A nice example is, let's say you as a company is an agent of another company. And then let's say you make $100,000 of sales, but actually the commission you are given as an agent is just 20%. Then would you have to report all that $100,000 of revenue, or are you supposed to just record that 20% of it? That's what we're just going to take a look at. So simply speaking, the standard speaks of how to recognize revenue. That's the main point here. And actually, there is a 5-step model listed so as to know how to account for revenue recognition. So before going to a 5-step process, we could just understand the meaning of revenue. Simply speaking, revenue is just income. Revenue is merely income arising in the course of an entity's normal trading or operating activities. Just like that. Let's say you are selling product A and product B, then the money obtained, the revenue you earn from selling those products, the income you earn from selling those products is called revenue. That's what we speak of revenue. What is revenue? What isn't revenue? Something like gain on disposal of non-current asset. Let's say you as a business have just decided to dispose of a non-current asset, let's say a PPE. Disposing a PPE actually would earn a certain gain to a company, or will make a company incur a certain loss on disposal. But if you have a gain, that gain isn't part of revenue. It's just a gain, it's not revenue. Note that when speaking of income, income could be in form of revenue or other gains. So that's how we go about it. And lastly, revenue in the statement of profit or loss should not include proceeds from the sale of non-current assets or sales tax. So you cannot say that you sold non-current assets. Let's say you dispose a non-current asset for $200,000 and then you use it as revenue. No. So neither its gain nor just the sales proceeds from the disposal of non-current assets should form part of sales. But also, I've spoken of sales tax here. Sales tax, in most cases, we refer to it as value-added tax, VAT, that indirect tax. So if you sell goods to a customer, having charged a VAT, you actually have to eliminate that, and so as to remain with the only revenue that that is exclusive of such sales tax or VAT. Let me give an example here of what I've just spoken of before going to the critical part of the 5-step process. This is what we'll do. Let's say you as a company expects to receive $100 million from a customer. This is what we expect to receive from a customer, just like this. But then you have to charge tax. That is VAT, sales tax or VAT, value-added tax. Let's say you charge a value-added tax of 20%, and this is just an example. If you add a value-added tax of 20%, what would be your amount? You would have 100 million here, and then you would plus 20%. 20% of 100 million equals to 20 million. So the invoice that you send to a customer would seem to have a revenue of 120 million, but in essence, there is something that you collect for the government. VAT is just an indirect tax that is collected indirectly, but it has to be taken to the government. So this 20 million is just the output tax. Now, how do you eliminate this 20 million from 120 million? This is what we do. So in case you are given with the 120 million with the tax, you just ask yourself, before tax, actually this amount was 100%, but with the tax was 20%. So this 120 million in full has got a total of 120%. Now you ask yourself, what amount of revenue actually would be there if there was no that tax? That is, if you would remain with 100%. So simply speaking, you will just have to post multiply and arrive at your answer. So to make matters easy, you just take your 120 million here, just take your 120 million like this, and then you multiply by 100 and then you divide by 120. So simply speaking, even without making this, even without dealing with these cross multiplications, you just have to take your 120 million, you divide by 100% plus tax rate, ending up with 120 and then multiply by 100. And doing this will actually make you end up with $100 million. So this is what we do. It was just a simple demonstration that is unlikely to be asked in an exam, but actually it's worth knowing. So let's go to a five-step process. Now here is where the key of this standard lies. This is the main point of the standard. IFRS 15 speaks of a five-step process. Actually, from the beginning up to the point of recognizing revenue, because the standard itself speaks of recognizing revenue. Do you see this? The standard speaks of recognizing revenue. So let's start here. Just before reading anything, this is what you have to understand. What do I mean by a five-step process? This is what I mean. There is a very common mnemonic that we use to remember the steps. We call it COPAR, C-O-P-A, and lastly R, COPAR. So you have to understand this. Actually, the last point, I would like to start with the last point, then I start from the beginning here. The last point is called R, means recognizing revenue. Recognizing revenue. This is the last point. Oh, sorry, I mean recognizing revenue. This is our point here. But all right, let's start from the beginning now. I just wanted you to understand that this is our aim, the aim of the standard. So this is the aim of the standard, revenue recognition. At the last point, we would have to recognize our revenue. So when speaking of C, the standard says revenue recognition from contract with customers. So first of all, you have to identify the contract. So we say here, identifying the contract. This is what we do. Identify the contract. If there is no contract, actually you got nothing to do, nothing. So first of all, there should be a contract, because if there isn't a contract, then you are actually not entitled to receiving anything. So you cannot start your thinking of recognizing revenue while you don't even have a contract. That's why you say identifying the contract. Actually, we'll see one step at a time in detail and actually look to the questions. But first of all, you have to get the full overview of what we're just going to take a look at. So we'll take a look at that. So first of all, you have to identify the contract. And then O means obligations, or we say performance obligations, actually. Performance obligations. Actually, you recognize revenue when you satisfy an obligation. You have an obligation to deliver a computer to a customer. You deliver the computer and then actually you can recognize the revenue. That's what we do. But actually there are obligations that take time. There are obligations that cannot be satisfied at one point in time. They're satisfied over a period of time. Let's say you have to build, to build, let's say a four staircase building, or let's say a 4-story building. If you complete one after another, actually you can recognize revenue. You have not one thing. The building could take, let's say, 3-4 years, etc. But actually, when speaking of revenue, revenue is an item of an income statement, and so it is recognized on a yearly basis. So you have to check the progress of where we've reached, what you have completed during a particular year, and then recognize it as revenue. So this is the performance obligation. So there could be more than one obligation. Let's say you have to deliver a computer, but also there is a warrant that actually maybe you are delivering a computer, but also you're offering services in case the computer maybe get malfunctions. You can just go there and rectify it. So you can have more than one performance obligation. So the main point of the standard is you recognize revenue as or when you satisfy your performance obligation. So there are very, very important points to note. You have revenue, you recognize it when you satisfy a performance obligation. That's what we'll be going through all the way. So performance obligation, let's say you have 2 or 3 performance obligations. We're just going to take a look at it, don't worry. The third point here is called identify the transaction price. Transaction price. What do I mean by the transaction price? Let's say you need to deliver a computer, but also you provide maintenance services. There are two separate performance obligations. Let's say maybe for both of the obligations, you would require let's say $2 million from the customer. Let's just presume that that's what you would require from the customer. So that's what we call the transaction price. But now you have to ask yourself, you have a transaction price as a single value, but you have more than one performance obligations. So this means that you would have to find out a way how to allocate that transaction price to each performance obligation. Because as we said earlier, revenue is recognized as the performance obligation is satisfied, right? Yes, you only recognize revenue as or when a performance obligation is satisfied. That's number one. Now, if that's the case, it only goes to show you that you have to allocate this transaction price with performance obligation so that when you satisfy that performance obligation, and then you have to recognize the transaction price that will act as your revenue. So that's what we have to do. That's why the other point here is about allocating the transaction price. So allocating that transaction price, so you break it down to each separate obligation. So you break down the transaction price to performance obligation, to PO's performance obligation. And then that's why after doing this, you would have your own, you would have your performance obligation to the price. This is what I mean here. Let's say you have the performance obligation number one, but also performance obligation number two, and let's say lastly, you have a performance obligation number three. And then you had a single transaction price. Now, by following what I've just said, you would break down your transaction price for each performance obligation. Let's say for performance obligation one, you would have a transaction price one. Then for two, you would have transaction price two. And for three, you would then have transaction price three. So after having done this thing, you know that you have a contract here, you know your performance obligation, they are here, three of them, and then you have your transaction price, that is here, and then you allocate it. This is what I've just done, allocating it. You will find out ways to allocate the transaction price, and then you are free. So when we recognize the revenue related to this performance obligation one, I would recognize it as or when this performance obligation is satisfied. And it would base on this TP1 transaction price one. So this is the basis of this standard. All what follows later will just be more details on what I've just spoken about and maybe further scenarios. So I think up to here, we can just go back to the steps and just go into details one after another. So it's just like that. Now we can just move straight away to a 5-step process. So as I just said, IFRS 15 said that an entity recognizes revenue by applying the following 5 steps. First of all, identify the contract, just like this. And then second, identifying separate performance obligations within the contract. So here we say that identify the separate performance obligation. Actually, the performance obligation should not be linked. They should be separate. What if you can't separate them? You will see actually at each step. And then the third one, determine the transaction price. I think I've illustrated all this already. And then allocating the transaction price to the performance obligations in the contract. You allocate your transaction price to performance obligations in the contract. After doing that, each performance obligation would be mapped to its respective transaction price. And so you could recognize revenue now when or if the performance obligation is satisfied. So we say here recognizing revenue. Now you have to note one thing. Actually, we'll see it later, but I would just like to illustrate it now. Here we say when. I just said when here, but here we say if. There are performance obligations that are satisfied just at a single attempt, but there are others that take time. So that's why you use words when and if. By saying as is just as it is satisfied over time. So you check the time that has passed and then you recognize the revenue corresponding to that time that has expired. So that's what we do. Now let's just go into details from one step to another. This is step one. So as I just said, step one, identifying the contract. You are still into that. You have to get into details on these steps because they are everything when doing the questions. So identifying the contract. Actually, the last step would be more crucial, but we have to take one step at a time because each step actually counts. So identifying the contract. This is just, I think, from your elementary studies of business laws, we just refer to the contract. You know the law of contract, we know all those conditions. So that's what we do. Simply speaking, when speaking of the law of contract, that means you have two parties, and all parties must satisfy must actually comply the obligation. There must be an obligation for each party, but also there must be consideration. So it's just like that. So we say here that IFRS 15 said that a contract, what is a contract? It is simply an agreement between two parties that creates rights and obligations. So when speaking of a contract, one party would have rights, but obligations to do something, as well as would another party be. It would also have rights, but also obligations. For example, I've sold a computer to you. I need to say, oh, maybe we have entered into a contract to sell a computer to you. That means I have an obligation to deliver a computer, but also I have the right to receive the money. What about you? You have a right to receive a computer, but you have an obligation to deliver the money. So that's why we speak of the contract. And actually, when speaking of the contract, actually, it should be enforceable. So the contract does not need to be written. Actually, the contract may be oral. It could just be oral, it could be implied, just like the normal business law terms. Right? So it's just like that. You go to a bus, you get onto the bus, and then you refuse to pay the conductor, saying that you had no contract, there was no written agreement. The conductor will die with you. So just have to be careful about this. So you're told here, an entity can only account for revenue from a contract if it meets the following criteria. So the following are the criteria on which you have to base on whether a contract exists or not. In case at least one of them is not present, actually you would not consider this as a contract, and so you would not consider recognizing revenue. So first of all, this is what we say. Parties have approved the contract and each party's rights can be identified. Parties, this is be identified, I think they are just connected. Parties have approved the contract. The contract is approved by both parties and each party's rights can be identified. Each party, it can be understood that each party can receive what, is entitled to receive what. This is what we call rights. Rights is just an entitlement to receive something. So it's just like this. But also we are told here that payment terms can be identified. How are payments going to take place? That's what will also be involved. But also the contract has commercial substance. The contract actually should have commercial, by saying commercial substance, that means there should be some implications, actually, some implications in cash flows, because if the contract has got no commercial substance. Let's take this example. You sell a Subaru, but also you get into a contract to sell a Subaru, but and also buy the same Subaru, same Subaru, same capacity, same life remaining, same risk. You find out that there is actually no contract. Why are they exchanging? Why the hassle while the items are actually identical? So that's why we say the contract has a commercial substance. Otherwise, no need to waste your time. And lastly, it is probable that the entity will be paid. By saying that you need to recognize revenue, it's because you expect to recognize that revenue. You cannot just recognize revenue which you do not expect. As you know, you recognize the contract that you do not expect actually is not allowed. So that's what I have to understand here. You find out that actually you recognize revenue that you are actually not going to receive. It's just a wastage of time. Let me give you an example. Let's say you have sold goods to a customer just from elementary studies. Let's just take this example to prove that it is nice to record when it is probable that the entity will be paid. Presume that you have sold goods to a customer for $100. What would be the double entries? If I sold and credit, I will write trade receivables here. I will write trade receivables, let's say 100, and then actually I would credit sales, or let's say revenue by the same figure, of 100, just like this. But if you take a great care on it, you would find out what. Let's presume that the customer undergoes bankruptcy. Becomes bankrupt. If the customer becomes bankrupt, that means that the customer won't be able to pay you. Then what would be the result? If the customer can pay you, you would have to write off these trade receivables, which would happen like this. You would have to debit bad debts. Actually, you have to write off bad debts, the income statement, 100, and then you would also have to write off the trade receivables. So I would credit trade receivables here. So writing this off would be 100. So after saying this, you had the trade receivables of 100, which will be written off, and then it will be written off by this 100. What have we remained with? You have revenue here, 100, but also you have bad debts, 100. Revenue is in the income statement, that increases the profit, and bad debts is an expense that reduces profit. So the net amount here would be 0. So that's why we say that in case there is it is not probable that you will be paid, there is no need to recognize this revenue here. That's why you have to check for the probability first. So this is what we'll go through. All right, then after here, we have to go to step number 2. All right, maybe before going to step number 2, I will just go and take a look at an example. Let's just go to an example and take a look before going further. This number 1 is 5 steps model. We'll just come and take a look at all these steps when you complete all the concepts on our steps. Let's just go to example 2. Yeah, here we are. We are at the right place at the right time. So let's read the question. The question says, BNB Limited has a year end of 31st December 20x1. And then on 30th September 20x1, that means before the year ends, 2 months is before the year ends, or I mean 3 months is before the year ends, BNB Limited signed a contract with a customer to provide them with an asset on 31st December 20x1. So the contract was entered into. And then we say control over the assets passed to the customer on 31st December 20x1. That means the control was passed. That means it was delivered. The customer will pay 1 million on 30 June 20x2. The customer hasn't paid yet, but control has been transferred. We say here, however, the transaction lacked commercial substance. I think this is pretty obvious. Since the transaction lacks commercial substance, we say that there is no contract. So there are ways that you need to keep your mind to. So say, since the transaction lacked commercial substance, the contract should not be accounted for, and therefore no revenue should be recognized. So you don't need to start contemplating about the amount of revenue that will seem to be 1 million. You should not recognize it at all, because actually there is no contract. In case it was silent, you could have considered that. So let me check if we have another. All right, I think that's all. So we should go to step number 2 and see what it also entails before going further and further and further. All right, so let's go to step number 2.